welcome to the podcast. I'm Rita Garwood, editor-in-chief of Monitor and ABF Journal. Joining me on the podcast today is Andy Blumenstock. Andy is managing director of Hilco Valuation Services. Welcome to the podcast, Andy. Can you tell
Yeah,
us a little bit about yourself and what you do?
great. Rita, thanks for having me. So as you mentioned, I'm a managing director in Hilco Global's Enterprise Valuation Group. We help investors, lenders, corporate clients, including lessors, understand the value of their businesses and their assets in a real world context. And for me, specifically in capital intensive transportation sectors like aviation, like rail, like maritime, which we'll spend a good bit of time, I'm sure, talking about today. Just as overview, Hilco, we're a global financial services and an investment firm. We have deep expertise in valuation, monetization, and then strategic advisory. So we really sit at that intersection of capital markets and assets of all stripes, tangible, intangible, you name it, which gives us a pretty unique perspective on how policy shifts, such as these 2025 tariffs, ripple through the markets and including the ecosystem that transportation equipment is in. So looking forward to talking with you.
Yeah, I'm looking forward to it too. So let's just start with the big picture. How have the 2025 tariffs disrupted the landscape for large ticket transportation assets, and what surprised you the most about the fallout so far?
Yeah, that's a great place to start. The 2025 tariffs really have shaken up the landscape for these asset classes, aircraft, rail cars, vessels. But what's been the most surprising is just how quickly and deeply these policies are starting to disrupt some of these very long-standing trade flows. So we're seeing ripple effects hit financing models, asset valuation models, and even supply chains, like it seemed like overnight. So the complexity, though, in terms of the global supply networks, especially in aviation, where a single aircraft could cross a gazillion borders before it's assembled, means that the tariffs are creating a compounding effects on cost. So what used to be a fairly stable field has become much more dynamic and of course, volatile.
So, looking across aviation, rail, and maritime, which sector has been hit the hardest from a valuation and financing perspective, and why?
Okay. Yeah, I think all three are starting to feel the pain, but in different ways. So aviation clearly stands out, as lessors and investors are dealing with some of those ballooning production costs, as well as tight supply and, an extension of some of these already long delivery timelines. That said, it's really hard to ignore the impact that maritime is facing with the disruption to international shipping routes, and impacts in just the trade volumes themselves. So all these factors, of course, some other things as well, are absolutely, hitting the valuations and some of those lending factors.
So, on the aviation front, you recently authored an article that I read before we had this interview. In it, you mentioned a potential $5 billion in added costs due to tariffs. How are lessors, lenders, and investors adapting to that?
Yeah, when I saw that $5 billion reported figure, I mean, it was a real wake-up call. I mean, lessors and lenders and investors, I'm sure were as well. And they're adapting by shifting some of those capital deployment strategies. I'm seeing a doubling down on the midlife aircraft trend, where yields have been stronger and you can avoid some of those delivery delays associated with new aircraft and the risk of kind of out the plant depreciation exposure. I'm also seeing a renewed interest in sale leaseback transactions, which, as you know, offer a way to kind of stay active in the market while avoiding some of those new build cost pressures. And from a debt perspective, some of the structured finance vehicle, like enhanced equipment trust certificates or EETCs, as they're commonly referred, are being repriced to reflect this heightened risk.
So, this strategy shift that you just talked about around midlife aircraft and sale leaseback deals, do you see this as a long-term trend or more of a short-term play?
Um, I given some of the well-publicized production struggles that are being that some of the aircraft OEMs are facing. There was already an existing trend towards midlife aircraft, but this added challenge of tariffs has just added another compelling reason, as I said, to double down on this aircraft profile. Ultimately, though, I think it's medium term, as these midlife aircraft unfortunately can't remain midlife forever. Years from now, this population of midlife aircraft, like all of us, will get older, and we'll be looking for those midlife aircraft, but they'll have been impacted by today's production challenges. So as valuations kind of modulate to those factors, we very well may see a willingness to invest in later stage aircrafts if valuations are holding up, where there is a financial justification to continue to maintain them. But the jury is still out on that. On your question about sale leasebacks, I think it's a little harder to say, but I'd lean towards it being more of a medium term thing, because I think the impact, on a longer term basis of interest rates and growth in developing countries and the demand for aircraft there will probably have more of a longer term bearing than what we're seeing right now.
So you also mentioned changing lease terms in aviation. What
Yeah.
kinds of structural adjustments are happening in real time, especially around maintenance reserves and cost sharing?
It's definitely evolving. I think we're going to see where it lands, but if history tells us anything, lessors and lessees are going to be exploring just more dynamic ways to deal with maintenance reserves, which are, maintenance costs are not immune to the tariffs. Obviously, the parts and the components that are used are also going to be faced by tariffs. So we're looking at maybe reserves that are tied to inflation indices or escalators linked to input costs, such as like steel and aluminum and all the key materials that go into aircraft. I'm also seeing more conversations around force majeure clauses tied to the trade disruptions, and even the introduction of kind of like a floating rate mechanism to, kind of share the fun of the volatility. All of this kind of reflects a growing awareness that lease terms need to adapt in this world that we're in.
So let's shift over to rail cars.
Okay, sure.
Um, with Trinity projecting a 20% drop in deliveries, that was announced earlier, what are the implications for equipment finance and ABL lenders who are active in the rail space?
Um, when I saw that projection from Trinity earlier on in the year, it really highlights the chilling effect that these tariffs are having. The cost of steel is going up, the customer confidence is going down, and these procurement cycles are just taking longer, and even longer than they were even previously. So for the equipment finance players and the ABL players, this means greater caution around expanding your fleets. There's also, I think, as usually does happen, a growing demand towards, stronger credit. And in some cases, deferrals or restructurings on existing leases where that credit just doesn't hold up. So it's becoming, I think, harder to justify these new builds without a real clear downstream demand.
So there's been growing talk of compressed lease spreads in rail. What
Yeah,
specific risks are private equity and lenders reassessing, like commodity exposure, car type, or something else?
yeah. Um, it's a real concern, and investors are definitely reassessing that risk. If tariffs alter the flow or pricing of key commodities like steel or agricultural goods, that can change the demand for certain rail car types almost immediately. They're almost 100% correlated. This creates, mismatches in risk between the car types and the lease pricing, which makes the underwriting that much more complex. So top of mind is commodity exposure, and certain types of rail cars are tied to specific sectors, like again, like in ag or in energy, that may benefit or suffer, under the new tariffs, I think, depending on how it all shakes out and the domestic ramifications. But car type, it matters. So some rail cars are more flexible and can be repurposed to different commodities, and we've seen those cars in the past come out the other side unscathed. Um, um, so on both the equity and the credit side, I think there's a little bit more of a granular look at this as risk mitigation, and factoring that in as part of just how you diversify your portfolio.
So let's shift over to maritime. In
Okay.
the opening, you mentioned that this area is also feeling shockwaves. How are tariffs changing trade patterns, impacting vessel-backed lending and the day rate dynamics?
Yeah, as I alluded to earlier, there's some real knock-on effects there. I mean, port activity is down. This past spring, I think it was May, imports at the Port of Los Angeles, one of the busiest ports in the world, dropped 9% year over year, which I think is as low as it's been in over 2 years. And that's putting pressure on day rates on container ships, especially on those Asia and US lanes. As we know, Asia has been a particular focus in the tariff discussion. So lenders are pulling back on new builds tied to like some of those tariff sensitive routes, or those input materials. Sometimes that can just be pulling back from a certain size, which may be prevalent in a certain route, and maybe a medium size vessel maybe for a different route. So it's a little bit more granular. But I think lessors are looking to offer some more flexible terms just to maintain utilization for these vessels. Um, I'm also starting to see a shift in focus towards Jones Act vessels. I fielded quite a bit of calls over the last 6 months, more than I have in a long time. And for those that aren't familiar with Jones Act vessels, they're US built and US flagships that are used in domestic maritime trade. And in domestic maritime trade, only Jones Act vessels can be used. So these are, as you can imagine, largely, pretty insulated from the international tariff risk. And so we're seeing that renewed interest as a result.
So in the article that I mentioned earlier, you noted a potential pivot into intra-Asia routes and LNG carriers. Is this
Yeah.
a real trend already in motion or just a theoretical shift on paper for now?
Yeah, I think it's still a little bit early, because these things do take time, but it's a real emerging trend, I think, that logically makes sense. You pivot capital into those intra-Asia shipping routes, which are ever growing and ever requiring larger ships. So they're obviously less exposed to that friction that the US and China have from a trade perspective. At the same time, the LNG, liquid natural gas carriers, are getting attention because they serve a little bit of a different demand profile. Energy security, global decarbonization, is still a major focus, particularly in Europe. So not just consumer trade flow. So LNG in particular is benefiting from that long-term global demand trend, with tariffs creating volatility probably in some other asset classes more so. So this is naturally going to impact fleet allocations.
So you also emphasized the importance of geographic and asset diversification.
Yeah.
What does that actually look like for lenders and investors who are trying to reduce tariff exposure?
Um, I'd say in practice, this means building portfolios that are less concentrated. When in doubt, diversify, right? So whether that's reducing exposure to one of the OEMs in aviation, or balancing commodity types in rail, or balancing the type of car types that you have that inherently are a little bit more nimble, or diversifying those trade lanes when it comes to maritime. Lenders are going to favor borrowers with diversified revenue streams and that international presence, particularly in maritime. So it's really about stress testing the exposure to those geopolitical and those policy shocks.
So we've talked about a lot of challenges so far, which there are many. Let's talk about opportunities and shift the conversation a little
Yeah.
bit. For value-focused or opportunistic capital, where are you seeing pricing dislocations or new entry points that are worth watching?
Um, So this is where it gets a little exciting, right? The dislocations in pricing, especially for midlife aircraft and container vessels, are creating some compelling entry points. Going back to your question on sale leasebacks, secondary trades, in those EETCs, and even off-cycle maritime assets are, offering yields that we haven't seen in a while. So the key is being able to underwrite the complexity and, kind of be able to move fast when you see a good deal.
So looking ahead, like 6 to 12 months,
Yeah.
what's the biggest wild card that could further reshape large ticket transportation asset landscape?
Um, yeah, I mean, the wild card is geopolitical. I mean, at the end of the day, that's kind of why we're here. We're in a tit for tat trade war, right? There's no other real way to put it. So a flare up in that, or hopefully a resolution in that, in those trade tensions could shift asset values pretty dramatically. Um, Beyond that, just, having finally, I think, settled into like a post-COVID supply chain world, we'll once again have to see where everything once again kind of recalibrates and how that impacts valuation and lease pricing and really the calculus that goes into good underwriting.
That was all the questions I had for you. Any final thoughts on this? Anything that we didn't cover that you think is important?
Um, really, we've talked a lot about the volatility. So, I mean, it's a dynamic moment for investors and lenders and other financial stakeholders in the space. I'd say for those that can be agile, can kind of structure around that risk with that diversification, with a line of sight on a bunch of the what ifs, there are real opportunities to generate yield and position for long-term value. The old playbook, which is starting to get really old, it's not going to cut it. And I think players have already started to learn that, but it's a new game. It's even more global, more geopolitical, and obviously that makes everything more complex. Um, and so those that can really model that out, you know, creatively diversify and hedge, but within the asset class and can act decisively, I think are going to be in the best position to win at the end of the day.
Well, thank you so much for
Yeah.
talking with me today, Andy. It's been great having this conversation and having you on the podcast. Appreciate you taking the time.
Yeah, Rita, great seeing you as always. Take care.
You too.